Hello and welcome to Portfolio Matters, week 21. And Richard is away on a jolly in Scotland hiking and is actually having some good weather, the bastard. So we have subbed in my old friend Stuart Owen, who you may recall did an excellent talk on his EIS and VCT investments a while ago. And before we get into everything, Stuart will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Okay, well, there was not much news in the markets this week. The couple of things. China barred banks from selling commodity-linked investments to the populace, which was an attempt to curb speculation and led to quite a sharp sell-off in commodities. And we'll go through this when we go through the checklist, but many of them have bounced back and some of them, particularly rhodium, had an incredibly bad week. The other thing was that both Shell and Exxon lost legal cases from climate change activists, which is forcing them to accelerate their plans to decarbonize. And both their share prices had a bad time, and we will talk about this as we go through. Okay, Stuart, do you want to go through some charts?
Absolutely. So here's a chart showing the change in UK consumer spending, comparing spending this year with 2 years ago, obviously missing out 2020 to try to get an effective base comparison. And basically, it's showing that people are out there spending. I'm doing my own bit for that, particularly when it comes to restaurant bookings, as we'll see in the next chart. So all systems go. And here's some data, again, from the FT, looking at the change in restaurant bookings. And we can see, it's 50, 60, 70% higher than 2019.
I know, that's an astonishing number, actually. So there's, 50% more restaurant bookings than there were pre-COVID.
And this is a particularly important point given central bank focus on employment, and we can see that hiring is really going gangbusters, certainly in particular industries, transport, logistics, warehousing. I think we all know the causes for that, given the rise of e-commerce. But also in more tangible things, construction and trades, again, sort of very, very strong. So, this obviously has impacts we would expect later down the road on wages and possibly in inflation. But so far, that is not evident in the statistics. I mean, these are only quarterly, and you can see they sort of move in 0.5% units. So it's a little bit higgledy-piggledy. But no evidence so far of expectations of big pay awards.
Yeah, I find this surprising, actually.
I wonder whether there's a background sort of fear of unemployment after having been through 2020. People are, still rather nervous.
Well, unemployment still is elevated. This is something to watch going forward. I would expect strong wage growth.
Now, I think the interesting line here is particularly the percentage of workforce on furlough. I hadn't seen this data until it came out in the FT. And it was difficult, I think, impressionistically to calibrate how many people were on furlough. So we can see that it peaked at about 30%, fell in the back end of last year to only 10, then rose to 20% before coming off again to around 10% of workers now. So the economy getting back to normal.
Yeah, I'm surprised it's still this high, though. I mean, you can clearly see the effect of the second lockdown as furlough goes back up to 20%. But I would have thought the economy really has opened up a lot, and I'm surprised it's still at 10%.
Well, again, it may be a question of when the data is collected, and perhaps that's still encompassing a lot of, say, hotel workers.
Yeah. Yeah, that is that the end of Q1? So things will have opened up further since then.
So here we can see some data about every UK person's favourite subject, that is house prices. In the left, we can see in the blue line the house price index, which has shot up, from an index value of about 150 to about 165, so a near 10% increase during a time of pandemic and an economic dislocation. Obviously, there's been a lot of comment about people changing the type of accommodation they want, perhaps moving out of London, looking for green space, etc. And of course, turbocharged by yet another temporary reduction in stamp duty. It's all rather scary from a generational point of view, and what people are going to do in the future, how children can afford houses, but this is the reality of the UK economy.
I find this chart absolutely amazing, actually. It shows what happens when people have more savings. They really want to put, in the UK in particular, they want to buy houses. But I would just wonder how much consumption has been brought forward. So we're looking at this chart thinking, wow, house prices are booming, sales of house prices are booming. But has that just brought forward a few years worth of house sales? And going forward, will we now see actually a decline from here, which would be a drag on the economy? And I think we don't know. We're just going to have to wait and see.
Well, I think there was some evidence from the first time that stamp duty was paused, reduced, abolished, that it did bring forward an awful lot of transactions. So that seems quite likely. Right, lest we forget, a lot of government largesse has been thrown at the economy, and this chart from the FT reminds us just of the scale of it. We can see 300 billion of UK borrowing last year, which compares to half that level during the 29-10 financial crisis. So these numbers are huge, and seemingly there's very little political will to raise taxes to pay it off.
Yes, a useful reminder of how much borrowing we are doing at the moment. Okay, now I thought this was a very interesting chart from the US, which made me kind of sit up because it seems to show that consumer confidence in the US has actually declined over the last month. And their plans to buy various goods has fallen, which is not what you would expect when I see a lot of charts in the US showing rising consumer confidence, the economy opening up again, and economic growth being very strong. So this is something which clearly shows the contrary of what I was expecting, and is something to watch, because if this is true, then economic growth may be weaker than we're all anticipating going forwards. And on that note, the US job vacancies are rising quickly. So, employment should be rising fast in the US. There's lots of data showing that employers are finding it difficult to find staff. US unemployment rate, the weekly data, is showing clear continued declines. So the economy is opening back up. So this chart shows that, surprisingly, Americans' expectations for their income have decreased. So they're not expecting to get pay rises in the next year. And given the recovery in unemployment, and for example, this next chart, which I apologize for because it's quite poor quality, I've had to scan in from the FT, which shows that employers are finding it difficult to find skilled staff. So this is the Manufacturing Availability of Skills Index, and it shows that American manufacturers are really struggling to find staff, which means that they should pay up. You'd expect an increase in the wages offered. Returning to inflation, the input price inflation is incredibly high, and you would expect that CPI is going to be elevated now with a lag. So we should see strong rise in US inflation over the coming year. Now, moving on to the US dollar. So the US has a big budget deficit, it has a big trade deficit, and it has low interest rates, all of which are incredibly bad or should be bad for the US dollar. And this chart shows that it's approaching a 7-year low, and the commentary was if it goes through that, it can decline much further. And it's difficult to see any positives for the dollar at this point, actually, unless you get a rise in interest rates. So historically, twin deficits, i.e. fiscal and trade, have been bad for the dollar. Okay, moving on. When we talk about inflation, I want to go right back to basics and to the theory of money. So PQ equals MV. Price times quantity equals money times velocity. And money, the monetary stock, has massively increased. It's increased by about a third in 18 months. Okay, so if you go back to PQ equals MV, M has increased by a third, which would mean as the quantity of goods is largely unchanged, you would expect price to go up by a third unless there's an offsetting decline in the velocity of money. And actually, that is what we've seen. The velocity of money has collapsed. So a lot of the extra money has been saved. But in order for the price not to increase going forward, the velocity of money has to remain subdued going forwards. And as the economy opens back up, I expect people to start spending, and also their appetite to borrow from banks whose balance sheets are now repaired and they are capable of lending, that also their appetite for loans to rise. And that means I expect the velocity of money to pick up from these levels on a massively increased monetary base. So I'm expecting inflation. Stuart, what are your thoughts?
Well, it's a very interesting comparison from a couple of years ago when we had similar increases, perhaps not quite as much, but similarly large increases in money stock. But a lot of that was seemingly sort of left as reserves at the banks, and it didn't get lent out. Whereas now, because of the structure of the way the federal largesse has been distributed to people, it seems more likely that it's going to be spent and used, and hence the velocity will pick up.
Yes, absolutely. So after the financial crisis, the financial sector was damaged and has had to rebuild its balance sheet. But also a lot of the stimulus was aimed at the financial sector, so QE, whereas this time it's been fiscal and it's gone into the hands of people who are willing to spend it, i.e. it hasn't gone to the rich, it's gone to the unemployed. And there has been a lot of saving because they haven't been essentially allowed to go out and spend it. And I fully expect that when they are allowed to go out and spend it, they will do so.
Now, this I found an interesting chart, which was an attempt to look at a previous period when there had been high inflation and whether it was persistent or not, which of course is the big debate we're all having at the moment. Everyone expects there to be high inflation this year, but will it continue? So this analysis was looking at the post-war experience in the US with very high rates of immediate inflation in 1947-48, but that coming way back down from levels of 15 to 20% for a year or so, back down to under 2%. And the argument is that this was a time when there wasn't expectations of embedded inflation, whereas the risk now is that we're all more educated about inflation. We've been through periods like the 70s of persistent high inflation, and that we could become in a situation where we get what we expect. And if that is inflation, then that will be what's coming down the pike.
Self-fulfilling prophecy, you're saying?
Yep.
Well, thank you for bringing this chart to our attention, Stuart. It's really interesting. I'm going to push back slightly, though, because I think a lot of these historic comparisons are dangerous because circumstances change. And the post-war period, the trouble is, during the war, there was vast amounts of fiscal expenditure, and there were price controls in the US. There was rationing and price controls. So a lot of the inflation you saw post-war, I think, is an inevitable result of prices catching up with where they should have been if there hadn't been price controls and rationing. And actually, if you look at cumulatively over this period, you're talking about 20% inflation followed by 10% the following year. That is a big, in 2 years, you're talking about, 35% increase in prices. So.
No, I think that must be the case in terms of when the inflation occurs, because it had been, as you say, suppressed by reallocation of resources. But I think the point here was not the creation of the inflation, but the response thereafter. Does it come down or does it get embedded?
Yeah. Okay. Okay. And while we're going back to basics and talking about inflation and the outlook for the economy, I wanted to go back to the GDP formula to remind everyone of the GDP formula. GDP equals consumption plus investment plus government spending minus savings plus exports minus imports. And last year, consumption was down, investment was down, government spending massively increased, as you've seen from the chart we showed earlier showing the UK government borrowed £300 billion last year. Savings were up, which depresses GDP, and both exports and imports were down, and we'll say they're neutral. Now, if we move forward to 2022, consumption's going to be up. People have got savings, they're going to spend those. Investment's up because the economy's opening up. Government spending will come down from its absolutely enormous highs, but the Biden administration is proposing a $6 trillion budget, including $4 trillion in infrastructure spending over the coming decade, plus further $2 trillion in short-term stimulus. So it's going to come down, but not by as much as you might expect. And also savings are going to come down, which is stimulatory. And both exports and imports are going to be up, and we'll say that's a neutral effect. But overall, if you feed that into the GDP equation, you get big numbers out. So I'm expecting very strong growth going forwards. Stuart, what are your thoughts?
Well, $1 trillion here, $1 trillion there. Soon you're talking big money. And I think what I worry about from this is the Fed's view that it's going to wait for evidence before it takes action, and by then it may be too late. It's not going to do anything preemptively. It's going to wait to see inflation. It's going to wait to see low unemployment before it does anything. And given the magnitudes of the numbers we're talking about in this equation, I fear they could be too late.
Yeah, but the thing I'd say is that inflation expectations remain incredibly well anchored, actually. And if you look at the bond market, as we will do so in a minute, the bond yields have been very subdued, and everyone seems to be buying the argument that this inflationary episode, which is certainly coming, is going to be transient, and then deflationary forces we've seen over the last 20 or 30 years will reassert themselves. And if I'm just feeding the numbers through this formula, though, you think the GDP is going to be strong, and the danger is that inflation picks up in a structural way.
Well, that's my fear, and that pulls back, I think, to your point about velocity of money picking up and the money stock which is now out there.
Yeah. Stuart, do you want to talk through COVID?
COVID. So broadly, good news. We can see in this chart from Bloomberg that the 7-day moving average of world cases is falling quite nicely. And the European Union, after obviously a somewhat slow start with its vaccination program, coming down very nicely indeed. All good news and good reason to think that the EU will be copying the UK and the US. But there's a bit of an exception in Asia. Now, I show here the chart of the 7-day rolling average number of cases per head of population, picking some Asian countries alongside the US and the UK. And what I want to show here is just the absolutely vastly different scale that the US and Europe went through compared to Asian countries since the beginning of the pandemic. If you think about the area under the curve as being the number of people affected, it's just a quantum difference. But over the past couple of months, there's increasing doubt that Asia can maintain its exceptional position, as many countries have been surprisingly poor at their rollout of vaccines, whereas to the extent that Japan now has more cases per head than the UK does.
Stuart, do you know what the vaccination coverage is like in Japan? Because I hear it's not actually very good.
It's a subject of great interest to me. It's only, I think, about 6% or 6 doses per 100 have been given in Japan. And that compares with, I think, we're getting on for about 70 in the UK now.
Wow.
And there are numerous bureaucratic hurdles. A doctor has to be present when you give the injection, rather than a nurse being able to do it as we can do in the UK. And the government doesn't have the right to insist on this. Everything is done via requests rather than a more formal, centralized policy and procedure. So it's not looking good in Japan, where there's also a huge degree of vaccine skepticism.
Oh dear, because that suggests that Japan will actually be in and out of lockdown, and things such as the Olympics or the Tokyo Marathon are very unlikely to go ahead with foreign participation.
Yeah, the Olympics is a great one, isn't it? No one wants to be the one to pull the pin and to take the legal responsibility for calling it off. And this looks at deaths rather than cases. And again, you can see the massive impact of the vaccine program in the sort of reddish line here, with the UK falling massively, and Japan again creeping up,
Oh.
and seemingly not having a structured policy to roll out the vaccines. And finally, on COVID, the emerging variant from first detected in India, here's the possibility of here we go again. I think the good news is that seemingly most of the vaccines, such as AstraZeneca and Moderna, do seem to be effective, particularly when there's been a double dose given, effective against the Indian variant. But we all will be monitoring this very, very closely.
Absolutely. Hopefully, we can all open up on the 21st of June as planned. Okay, moving on to the checklist. Well, in general, it was another strong week. The all shares up 0.9%. The S&P 500 up a further 1%. NASDAQ recovered, up 1.5%. Japanese Topics was up 2.2%. Bitcoin, having had an absolutely terrible last week, fell further. There was a bounce, but not a very strong one. And sterling continues strong. Stuart.
Yes, this chart really grabbed my attention. It comes from GMO investment advisors, who have been famously bearish on equity markets. And in their latest quarterly, they were looking at this issue of whether we're in an everything bubble. Now, normally, you might think of looking at this issue, thinking about from the demand side. Are people getting wildly enthusiastic about things like crypto, etc.? But what they were looking at was turning that problem around and saying, well, actually, in a capitalist system, that often has a way of providing what people are looking to speculate on. So this is a chart looking at US equity issuance as a percent of US GDP, where you can see that the ravenous desire for stocks is being fed by a ravenous supply of stock. which you might think of as a rather a warning sign if the market is being diluted and frothy equity is being pushed out there.
Well, thanks for including this chart, Stuart. I think it's really interesting because actually what this is showing is there's enormous investment in this by the stock market in companies. And historically, when you've had peaks like this, there's been an enormous amount of malinvestment. And if you look at the internet bubble, forwards 3 years, it turns out the vast majority of that money was wasted. And, when you look at this, you think there's too much money in too short a time. A lot of that will have been wasted on companies that really shouldn't have been IPO'd.
Absolutely. And I think we see some of that in the next chart as well, in the even more speculative area of the market, the famous SPAC area, the blank check companies, where it's never been seen before at this level. And GMO's case is that this is taking money from credulous investors by promoters who observe that now's the time to get the money on board. Thank you very much. Moving on to GMO's conclusion from all of this, which is a very bleak outlook for asset market returns. They have an interesting approach where they try to forecast asset returns by fading the market's valuation level back to an average and fading the earnings of the market by looking at mean reversion in profit margins. Basically, using this approach, the US equity market is forecast by GMO to be offering a real prospective return of about -8% a year. And non-US markets not looking much better, -1 or 2%. And the only spot of light is a subset of the emerging market stocks, emerging market value stocks, where even there, the prospective returns using this sort of measurement technique are only about 2% real. Fixed income, of course, just looks absolutely horrible given the initial starting yields.
Yeah, no, this is really interesting, but I'm going to push back hard on this, actually. I think we're in extraordinary times and interest rates are really low. And so I just can't see how anchoring to historic norms is relevant when interest rates are well outside historic norms, and they're what decide asset prices. And as we just talked about, we're about to see a period of very strong GDP growth leading to very strong corporate earnings, you would expect. And I just can't see equities crashing. And you're talking about, minus 8.5% a year going forward when the next few years we're expecting strong GDP growth. I mean, this may be true medium term, but it would come after a crash of some kind. And crashes always occur when you have a recession. So I can't see it.
Well, just one gentle pushback to your pushback, Keith.
Yep.
I think one issue is that if interest rates remain low to justify current valuations, that must also imply something about structural growth levels. So the equity market can't have it both ways. It can't have the upside to valuation from low rates, but still expect the growth to be there systematically.
I completely agree. If rates start rising rapidly, then all bets are off. However, Stuart, one thing I've been absolutely wrong on this year is I was expecting rates to rise strongly because of all the things we've covered. And as we'll go through, they ain't, they're being actually surprisingly subdued, which, which supports equity prices. And if bond yields start rising, as I expect, then yes, then this may, all bets are off and we'll have to reconsider. But right now, that scenario you outline where, the equity market can't have it all ways. Well, right now they are, because bond yields are not doing what we're expecting them to.
It is extraordinary, isn't it? Yep. Now here's a very interesting chart sourced from myself and my own back of the envelope calculations. Here I'm trying to look at price to 10-year earnings ratios, i.e., the Shiller Cape ratio, but for non-US markets as well as the US. And So this is showing the US as an outlier on something like 35 times trailing 10-year earnings. And I just think this is the elephant in the room.
Yeah.
We all know it, we all see it, and we all do nothing about it. Non-US markets looking much more reasonable, sort of 15 to 20 times.
Yeah. Well, the reality is that, betting on these US tech companies has been the trade of the last decade. And, Tesla, how many of us were think that the valuation is absolutely obscene? But, the reality is it's been a great investment over the last 5-10 years.
It has been a great speculation, hasn't it, Keith?
Absolutely. And, but going forward, we expect some air to start coming out of the bubble. Okay, so Richard is away. And so our resident Bitcoin expert is away. And this is me. I have discovered a great article, which I've shared on our Discord for anyone who's interested. And it talks about how a lot of Bitcoin purchases are actually via Tether. And Tether has been, how can I put this politely, either artificially supporting or manipulating the Bitcoin price. And the thing is, none of the regulated exchanges will touch Tether. So what is happening is people are buying Bitcoin on the regulated exchanges like Coinbase, where you are allowed to buy Bitcoins with dollars. And then using those Bitcoins, they go onto the unregulated exchanges where there's a lot of leverage. You can leverage up about 100 to 1, apparently. And Tether is meant to be pegged to the US dollar with an asset. So one Tether is meant to have an actual backing of $1. But this article raised very serious questions about whether that was true. And it's obviously all in cyberspace. And, I don't think anyone really knows. So anyway, it's a great article. If any of you hold Bitcoin, I would recommend joining our Discord so you can access it. But it's the link is bottom right. And Bitcoin had another bad week. Okay, moving on to the industrial commodities. Now, as we talked earlier, China has cracked down on banks offering commodity products to consumers, and that's led to quite a large sell-off in iron ore, but above all in rhodium, which we will cover later. So quickly going through it, aluminium was essentially flat, as was cobalt. Copper was down 0.5%, but remains very elevated. Chromium is picking up. Now, chromium has not recovered to its pre-COVID levels and is doing so. Iron ore continues to come off, down 6.1% on the week, but it had an extraordinary spike over the last few weeks. Lithium is flat. Neodymium continues to drift off, down 1.3%. Nickel flat. Ferrovanadium very strong, up 5.8%. WTI very strong, bouncing back from last week's dip, up 8.2% to almost $67 WTI. Although sadly, oil companies had a rather indifferent week. We will go into that. And uranium was flat, up 0.3%. Stuart, do you want to talk about this?
Sure. So this was a fun article in the FT looking at a different side of inflation and something we're all concerned about, which is a good English fry-up and a bowl of porridge. Basically, how inflation is evident in all the commodities feeding through to a breakfast.
Yeah, and some of these numbers are big, like pork up 57%, coffee up 52%, wheat 31%. This will affect the poorest people in society who spend the most on food as a percentage of their income.
And putting all that together, here's a couple of indices of the breakfast commodities and breakfast commodities including pork. And you can see a massive rise from a year ago of index values of around 100 to about 130 now. So some pretty substantial inflation in some real commodities.
Okay, now I thought this was interesting, and this shows how copper seems to have decoupled from China and is following actually Western PMIs, so European PMIs, rather than Chinese ones. And so has the West now become the marginal buyer of copper due to all its investments in green energy? Something to watch going forward. This is the copper chart, which still looks linear, frankly. Iron ore, yeah, clearly there was a bit of froth, and it's had further declines last week, despite a bounce of the last couple of days. But you know, that by historic standards, that is still a very strong chart. Lithium was flat on the week. Chromium, which is mainly used in stainless steel, is recovering to its pre-COVID levels. Neodymium continues to drift off. This is ferrovanadium, which also had a very strong week. So holders of Bushveld and Ferroalloy Resources should be happy. But it seems that iron inputs are catching up with the iron price. Okay, moving on to precious metals. Gold continued to recover, up 0.9%. Silver followed it up, but silver's generally geared to the gold price, and recently has not been. So it was only up 0.3%. Platinum had a poor week, down 1.1%. Rhodium had a terrible week, down 19%. Palladium down 1%. So gold, this is a gold chart, and that is looking strong, and is briefly popped over $1,900 an ounce, but is still, the recent uptrend is very much intact. Silver following it, but actually not as strong as gold. Platinum seems to have stalled. Now this is rhodium. And if you remember, rhodium is the most effective catalyst for turning the various nitrous oxides, NOx, breaking them down into nitrogen and oxygen. And the new EU emission standards come in September, and Goldman Sachs earlier in the year had been forecasting rhodium would reach $100,000 an ounce. Bear in mind, gold is only $1,600 an ounce or $1,800 an ounce. Big question is that sustainable, particularly given the move to electric vehicles? This latest, the sell-off would seem to suggest that there has been actually quite a lot of speculation involved. And if you look at a chart of rhodium from a different provider earlier in the week, they were saying that the rhodium price had absolutely collapsed. So it was down 40% in 5 days to $16,500 an ounce, which is substantially different from the data you see on trading economics. Now, the thing to say about rhodium is that it's a very small market and pricing is opaque. So it would seem that the Kitco numbers were probably wrong, but there certainly has been a sell-off, quite a big sell-off in rhodium. Conversely, palladium picked up a bit. Okay, moving on to rates. Well, again, rates fell. So bond prices had a good week, which is surprising. Stuart, do you want to talk through these?
Well, here we go again. Despite all the economic news, US real rates are massively low at the same time as the dollar index falling. It's difficult to see from an investment perspective, why you'd be involved in fixed income. It's just mind-boggling.
Well, because we've seen recently, US CPI has been picking up and rates have been going down. So the real rate is just collapsed.
Now, this next chart is a different way of looking at prospective US equity returns. It's presented as a discount rate, but the calculation to achieve it is quite interesting. It's a bit complex, but worth bearing with. There's a company called Holt who look at equities and try to put them into a bond-like framework by looking at the cash return on capital employed in those businesses. Now, what you can then do is project forward the cash flows you're expecting to earn from a bunch of equities, in this case, the whole US market, and discount that and then examine the price you're being asked to pay for those prospective earnings and calculate a discount rate that solves for that. And basically, this is another way of looking at the extreme valuation of the US equity market. So the 2% interest rate is what solves for the current price of the US equity market, given the prospective cash flows, i.e. very, very low. And another depressing chart, if one is looking to make a prudent investment, this is the yield on high yield bonds, i.e. high risk bonds, but the yield available is not even 5%. And that compares to over about 12% during the depths of the pandemic in March last year. So given default rates, prospective returns seem appallingly low.
Well, this chart is basically showing that the market believes that junk bond companies are the best bet they've ever been.
In the sense of their likelihood of defaulting, and that seems to be the case. Now, one reason why that might be is this somewhat surprising chart, or at least initially surprising, where we're looking at a chart of credit score changes. And we can see on the right-hand side of the chart, unsurprisingly, in the red bars during the stages of the pandemic last year, credit quality deteriorating. But just recently, that's all turned around, either from the prospects of being able to get cheap borrowing or from the improving economy, but credit scores have been nudging up. And that was the picture in the US, also a similar pattern in the UK as well. Yes, slightly less positive for European Union, but I think we can expect that to turn around as the vaccine rollout accelerates and the economy recovers.
Okay, so this is the UK 30-year gilt yield. And you'll see in recent months it's actually ticked down. But by historic standards, it is extraordinarily low. And if we think the market, the economy is going to normalize, you'd surely expect the 30-year gilt yield to start to normalize, which would be to move back towards 3%. And given the increased levels of debt in the economy, that surely would then be a drag. But right now, we are not seeing it.
It is quite extraordinary, isn't it? I mean, 1.3% to lend to inflation-prone UK for 30 years. It's I mean, what's the phrase these days? It's sort of return-free risk almost. Yeah,
well, exactly. And particularly when the government borrowed 300 billion sterling last year, and the Bank of England monetized half of it. Actually, I don't know whether it was half, but certainly a big chunk of it. It's extraordinary. And in the US, again, the 10-year yield having risen very rapidly between August last year and March is now flat over the last few months. And so people are seeing the current rise in inflation in the US and elsewhere as transient. And this is our favorite chart, the seasonality chart, which does a lot better job at forecasting the markets than we do. And we are here, and last week should have been a decent week, and it was. The next week should be okay, and then not so good. Sell, according to this chart, it's sell in early June and go away to October. So, okay, and now let's move on to our portfolios. So, Stuart, do you want to talk us through your portfolio?
Sure, will do. I'm trying to tell myself that I'm an investor, not a speculator, not a trader. So I'm going to try and take a 30,000-foot perspective. I was very struck with a remark in a novel I was reading once, criticizing a middle-aged man for dressing in the fashion of his youth. I suspect I'm the investment equivalent, investing in the fashion of my youth, trying to focus on value, which means that I have not been taking part in Tesla, for instance. So how I look at my SIP, I don't think I've got a very great advantage in terms of being nimble and changing my investment positions quickly. So I'm trying to cover off every possibility, accepting that that will lead to a very diffuse portfolio. So I'm trying to cover the risks of a monetary accident. I mean, all this money printing worries me. My central scenario is some sort of muddle through. Somehow we'll get along and revert back to some modest growth level and modest inflation. But I equally have a fear that there could be a very high inflation. So I've tried to have exposures covering each of those scenarios. So the monetary accident, I think cash and gold are reasonably consistent, well-covered stories to give protection against a monetary accident. But one other exposure that I've got to try to head off some of that risk is an Asian fixed income ETF. And the logic here is that a lot of the money printing has happened in Europe, the UK, Switzerland, Japan, and the States. But actually, there's quite a lot of Asian markets which have not been quite so profligate in their money creation. And if I can earn 2.5–3% income from that, that gives me some hope that I might be in the right area of currency exposure if there's a monetary accident in the West. My main bet is muddle through, that somehow we're going to get back to, say, 2% growth in the developed world, perhaps 4 or 5 in the emerging world. And so my bets in that area are to focus on non-US equities, picking up on some of the analysis like the price to 10-year earnings ratios. But also, given that I expect growth to be fairly modest, I've got exposure to some infrastructure stocks which give a reasonable yield, growing by inflation most years, a bunch of REITs, real estate investment trusts, many of which have got some RPI or CPI-linked contracts backing them, and some income-focused investment trusts that offer 6–7% returns, which I find attractive given the prospective returns from equity markets. In terms of a high inflation outcome, well, gold again, a buy-to-let property backed with some 5-year fixed rate debt to have that debt inflated away perhaps, and some commodities via something as simple as a FTSE 100 ETF that gives quite a diversified exposure to that area of the market.
Very interesting, Stuart. So this strikes me, it's like you are running a professional pension fund or so, with very well diversified, both geographically and across assets. So you're taking a very long-term approach and so not really changing that. Is that kind of right?
Yeah, that's sort of true. I do remember I was reading one book about investment and the early days of working in the industry. And it said, think of investment as a game, and what advantage do you have compared to the other players? And, as a private investor, you don't have really, I think, an information advantage. You don't have a trading cost advantage, a processing power advantage. But I think you've got 2 advantages compared to a professional investor. One is to be nimble, that because we're small, we can get in and out of esoteric positions quite quickly. And if we change our mind, we can move the portfolio quickly. And I sense that that's the sort of thing that interests you, Keith. Whereas I think the other advantage that you've got as a private investor is that you can be patient. You don't have to answer to an investment committee in the short term. And that's probably something that I'm trying to pick up on, making long-term value-based bets and not having to answer for the underperformance that a value-based approach has given in the past few years.
No, I completely agree that one of the advantages you have as a private investor is that you don't answer to the investment committee and you can be very patient. And actually, one of the main sources of my outperformance has been I have tended to sell everything at points in the cycle and actually spend years in which the portfolio is entirely in cash or bonds, waiting for what I see to be an inevitable crash. And, sometimes I've been two or 3 years too early, but then when the market's down 30% and you've got cash, suddenly you can look very clever. Yeah, because that's not something you can do if you're a professional.
I just think temperamentally, I'm not suited to making those very big swings. I'm more like I evolve the portfolio.
Yeah, interesting.
Performance, I'm not going to present a weekly performance statistic given that investment philosophy.
Yep.
But I thought I'd cover the year-to-date number, which is 6.2%. So some of that comes from the drip of income. I'm a complete sucker for a reasonable yield. And across my portfolio of things like infrastructure, stocks, asset-backed lending, some renewable infrastructure trusts, that boosts the overall portfolio yield to just over 4%. So in any particular month, not much, but it obviously compounds up over time.
What sort of performance are you aiming for, Stuart?
Well, if I can get 5 to 6% a year, that's what I'm hoping for at the moment. I mean, I don't particularly believe literally the GMO forecasts, but it is in the back of my mind that, my goodness, we're in the everything bubble. Everything is priced up. And if I can earn a good chunk of the total return from a reasonably sustainable dividend, that gives me a bit of a comfort blanket.
Absolutely, because actually people forget just how effective compounding is. If you can avoid the drawdowns and you have a very conservative portfolio and you can make 6 or 7% a year, that doubles your money every 10 years, 7%. So
absolutely. Yeah.
Moving on to me. Okay, so I had frankly a very disappointing week, up 0.4%, and BP and Shell, the as you've seen from the checklist, the oil price was strong, BP and Shell were weak. And that is essentially the story of my year so far. I have a big bet on oil and the oil price is going up, but oil companies ain't. But at some stage, fingers crossed, I expect that to change. So I was at 0.4%, which takes me up 5.4% on the year, massively lagging the all share, which is up almost 10%. Now, I sold a few things this week. The biggest one by far was Hochschild Mining, which is a silver producer in Peru. Earlier in the year, it was one of my best performing stocks. I had more than doubled my money. And then I bought more and it has drifted off. The silver price has recovered and it's kept on drifting off. Now, you will be aware from previous weeklies that the Peruvian elections are coming up and the leading candidate is a socialist who's intending to raise mining taxes. And actually at one stage was talking about nationalizing all the miners, although he seems to have stepped back. And I think until that is clarified, the Peruvian miners will probably struggle. And also, I just didn't like the way it wasn't responding to a rise in the silver price. So I have sold for a 33% gain, which looks all right. But bear in mind, at one stage, I was more than doubled my money. Also, I sold my Sylvania Platinum and Jubilee Metals, which I know a lot of people who follow us have in their portfolios. I saw the fall in the rhodium price, and frankly, my feeling about both the companies is that I'm late to this game, in that I bought in when the share price had already gone up quite a lot. And I see a summer sell-off coming, and I wanted to trim the portfolio to give myself some cash. I only bought one share, which was Diversified Energy for my SIP. Diversified Energy we have covered previously and has a yield, which I think is sustainable, of 10.7%. And that compounds up very nicely. So this is Hochschild. You can see I bought it right down here. And then at one stage it was over £3 and it's since drifted off. And I don't like that chart, essentially. Above all, I didn't understand it. This is Sylvania Platinum and fall in rhodium. If fall in rhodium continues, then that will have quite a large knock-on effect for Sylvania, which makes a lot of money from rhodium, and Jubilee the same. So having made decent money, I'm out. Now, Rambler had its AGM this week, also had a share consolidation, 100 to 1, which has brought its share price into respectability territory. Instead of being 0.4p, it's now 38.6p, which is much more sensible. It also announced new resource estimates, and the Ming mine, they estimate, contains 410,000 tons of gold. That is a lot, and a 1% cutoff. And that's measured and inferred and excluded indicated. So they have a big resource. The question is, can they mine it profitably? This is what I bought, which is now, it used to be diversified gas and oil, but it's now diversified energy. It has gone X, and the share price has come off in the last couple of days. But it's announced a deal recently where it has bought more assets in the new central region. So that, in this case, is the Barnett Shale. They bought 820 operating wells with 16,000 barrels of oil equivalent per day of production. And they bought it at an EBITDA multiple of 3.5. The dividend is currently yielding 10.8%. And, compounded over 10 years, that adds up to an enormous return. And so, in fact, if I could get that every year from the whole portfolio in the SIP, I'd be ecstatic. So bought that, stuck it away. Okay, well, I think that is us done for the day. Thank you all for sticking to the end, and thank you very much to Stuart Owen for subbing in and adding a bit of diversity to the presenter mix. So in the meantime, I hope you will press like and subscribe to the channel, and it is goodbye from Stuart Owen.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.